The financial landscape is filled with isms, cliches, and fallacies about money. It's often hard to know what is fact and what is not. Even top finance gurus do not agree on what the best way to manage your finances is, but every individual's circumstances are different. It is important for everyone to educate themselves and learn about personal financial management. Here we dispel some of the common myths to help you on your journey to financial literacy. Myth 1. Always save 10% of your income. This myth originated from rudimentary financial advice that often lacks context or analysis of individual circumstances. It's simply a convenient, straightforward, easy-to-remember rule that most people could follow. In reality, a flat 10% might be inadequate for some and excessive for others, depending on factors like age, income level, existing savings, and retirement goals. A more tailored approach would involve creating a detailed financial plan, factoring in your current financial obligations, future goals, and unforeseen contingencies. Use retirement calculators and consider speaking to a financial advisor for a personalized strategy.
Myth 2. Renting is throwing money away.
This myth comes from the intrinsic value placed on property ownership, particularly in Western societies. Owning real estate is often equated with financial stability. In reality, renting can be a financially savvy move, depending on location, job stability, and life circumstances. A study from the National Bureau of Economic Research found that owning a home may not be the most lucrative investment compared to other financial assets. It is important to weigh the costs of maintenance, taxes, and mortgage interest against the benefits of property appreciation and tax deductions. Also, consider your mobility needs, career trajectory, and local real estate market before making a decision. Myth 3. You need a high income to invest. The idea may stem from the perception that investment is complicated and risky, suitable only for those who can afford to lose money. In reality, investment is not solely about large sums of money. There are investment options like ETFs, exchange-traded funds, and index funds that are accessible to people with lower incomes. Research has consistently shown that investing consistently over time, even small amounts, can result in substantial returns due to the effect of compounding. Consider starting with low-cost, diversified investments. Invest what you can afford and aim to increase that amount over time. Educate yourself or consult a financial advisor to understand your risk tolerance and investment objectives better. Myth 4. Carrying a credit card balance improves your credit score. This myth likely came about through a misunderstanding of how credit utilization and credit history affect credit scores. In reality, carrying a balance increases your credit utilization ratio, which can negatively impact your credit score. According to the Fair Isaac Corporation, FICO, high utilization can be a red flag indicating financial distress. Aim to pay off your credit card balance in full every month to maintain a low credit utilization ratio. Keep track of your credit score and report, using them as a tool to guide your spending and debt repayment behaviors. Myth 5. Active investing beats passive investing. The myth comes from the allure of beating the market and the fame garnered by successful active fund managers. There's a notion that skilled management can consistently outperform market indices. In reality, research, including that by Eugene Fama and Kenneth French, suggests that most active funds underperform their benchmark indices over the long term, especially after fees and taxes. Passive strategies like index funds typically offer lower fees and better long-term returns for most investors. For most individual investors, a diversified portfolio of low-cost index funds or ETFs offers a more reliable path to long-term wealth accumulation. This approach aligns well with the efficient market hypothesis, which posits that all available information is already reflected in stock prices, making it difficult to consistently beat the market. Myth 6. Gold is the safest investment. Gold has been traditionally seen as a safe haven due to its tangible nature and historical value. During times of economic uncertainty, people often flock to gold as a safety net. In reality, while gold can act as a hedge against inflation and currency fluctuation, it does not generate income like bonds or stocks. According to multiple analyses, including those from the Federal Reserve, gold's long-term returns may not be as robust as equities. Gold can be a part of a diversified portfolio but should not be the sole focus of your investment strategy. A balanced approach that includes multiple asset classes is generally more effective for long-term wealth generation.
Myth 7. All debt is bad.
The aversion to debt likely comes from cautionary tales of people falling into spiraling debt, leading to financial ruin, or from advice given by popular online financial gurus. In reality, not all debt is bad. Good debt can be an investment that will generate long-term income or increase in value, such as student loans for a valuable degree or a mortgage for a home. Research from the Harvard Business Review indicates that strategic use of debt can often lead to better financial outcomes when used judiciously. Dave Ramsey will obviously disagree. Differentiate between good and bad debt. Manageable levels of good debt can be beneficial if it leads to an appreciating asset or higher earning potential. Always have a clear repayment strategy in place.
Myth 8. Social Security will cover your retirement needs.
Social Security was designed as a bare minimum safety net, and many people assume that it will be sufficient to cover their expenses during retirement. In reality, according to the Social Security Administration, Social Security benefits are meant to replace approximately 40% of an average wage earner's income after retiring, which will not be sufficient for most people. It is advisable to have multiple streams of income during retirement, including personal savings and investments. A comprehensive retirement plan should not solely rely on Social Security benefits.
Myth 9. Financial planning is only for the wealthy.
The idea that financial planning is reserved for high net worth individuals likely stems from the costs associated with hiring a financial advisor and the perception that only wealthy people have assets worth managing. In reality, financial planning is essential for everyone, regardless of income level. Research from the Certified Financial Planner Board of Standards, CFP Board, indicates that people who engage in financial planning tend to be better off in the long run compared to those who don't. You could use free or low-cost financial planning tools, and consider consulting a certified financial planner on a fee-only basis if you can't afford ongoing services. Financial planning should be a regular practice, incorporating budgeting, investing, and long-term goals.
Myth 10.
Stocks are risky, bonds are safe. This dichotomy likely arises from the relative volatility of stock markets compared to the more stable nature of bonds, especially government bonds. In reality, while it's true that stocks are more volatile, they also offer higher potential returns. Bonds, though less volatile, can still carry risk, especially in a rising interest rate environment or if you hold low-quality corporate bonds. A paper published in the Journal of Finance noted that diversification across asset classes minimizes risk and potentially maximizes returns. A diversified portfolio containing a mix of stocks, bonds, and other asset classes based on your risk tolerance can offer a balance between risk and reward. Always assess your financial goals and risk tolerance before deciding your investment mix.
Myth 11.
Tax refunds are a good thing. The appeal of receiving a lump sum from the government has led people to view tax refunds as a form of forced savings or even a bonus. In reality, a tax refund essentially means that you have given the government an interest-free loan. You could have invested that money throughout the year. Multiple economic studies highlight the opportunity cost associated with large tax refunds. If possible, aim to adjust your withholdings so that your tax liability is more accurate, freeing up money to invest or save throughout the year. Speak to a tax advisor for personalized guidance.
Myth 12. Financial success is all about earning more.
Society often equates high income with financial success, possibly due to the visibility and prestige associated with high-earning professions. In reality, financial success is not solely about earnings but also about effective money management, savings, and investment. Saving rates tend to vary widely regardless of income. Focus not just on increasing your income but also on budgeting, saving, and investing wisely. Financial literacy and discipline often outweigh high income in the path to financial security.
Myth 13. Pay off all debt before investing.
The concept behind this myth is rooted in the aversion to paying interest on debts, which is perceived as money lost that could otherwise be invested. While high-interest debt should indeed be paid off as quickly as possible, delaying all investments until all debt is paid may result in lost opportunities for compounding growth. Research on the time value of money illustrates the importance of investing earlier rather than later. The takeaway is that a balanced approach might be more beneficial. Prioritize paying off high-interest debt while also making modest contributions to retirement accounts or other investments that compound over time.
Myth 14. Annuities are a reliable retirement solution for everyone.
Annuities are often marketed as a guaranteed income stream in retirement, making them sound like a one-size-fits-all solution. The reality is that annuities can be complex and come with fees and restrictions. They may not offer the liquidity or returns that other investment options can provide. Research, including a paper published in the Journal of Risk and Insurance, warns against the limitations and costs associated with annuities. It's important to scrutinize the terms and conditions of an annuity carefully. Consider other options like diversified investment portfolios that can provide a better risk-adjusted return based on your individual needs.
Myth 15. Your home is your best investment.
Homeownership is deeply ingrained in the American dream, and many people view their homes as a form of forced savings and investment. The reality is that while homes can appreciate in value, the actual returns when adjusted for factors like maintenance costs, property taxes, and inflation may not be as impressive. Academic studies like the one published in Real Estate Economics suggest that residential real estate generally underperforms equities over the long term. The important lesson here is that it's crucial to view homeownership through the lens of both an investment and a consumption good. Don't rely solely on home equity for your retirement savings. Make sure to diversify your investment portfolio.
Myth 16.
Your credit score only matters when buying a house or car. This myth is propagated due to the high visibility of credit checks in mortgage and auto loan processes. Your credit score can impact other aspects of your financial life, such as the interest rates on credit cards, eligibility for renting an apartment, and even your employment prospects in certain industries. A research paper from the Federal Reserve has highlighted the broader implications of credit scores. It is advisable to regularly monitor your credit report and score, and take steps to improve it if necessary. Your creditworthiness has a far-reaching impact that goes beyond securing loans for big-ticket items.
Myth 17.
You should always prioritize saving for your child's education over retirement. The emotional pull to provide for one's children often sways individuals to prioritize their children's education over their own long-term financial well-being. We find that while saving for education is undoubtedly important, compromising your retirement savings can put you at financial risk in your later years. Financial planning research suggests that while education loans are available, the borrowing options for retirement are more limited. It is better to focus on a balanced financial strategy. Make adequate contributions to your retirement savings before setting aside money for education funds. Multiple avenues can help fund education, but your retirement needs a solid financial backing.
Myth 18. You shouldn't invest in the stock market as you approach retirement.
This myth likely originates from the idea that stocks are too risky for retirees who won't have time to recover from potential losses. While it's advisable to have a more conservative asset allocation as you age, maintaining some level of equity investment can provide the growth needed to sustain a longer retirement. Studies published in the Journal of Pension Economics and Finance have highlighted the importance of this balanced approach. It might be a good idea to shift toward a more conservative asset allocation as you approach retirement, but keep some equities in your portfolio to help combat inflation and increase potential returns.
Myth 19.
Financial advisors are only for the rich. The belief here stems from the notion that financial advice is costly and therefore only accessible to those with significant assets. The rise of robo-advisors and fee-only financial planning services has made financial advice more accessible to people at various income levels. Research in the Journal of Financial Planning has shown that even moderate-income individuals can benefit from financial planning.
What you should do is
explore various forms of financial advice, including online platforms and traditional advisors, to find a service that fits your budget and needs.
Myth 20. You can reliably pick winning stocks based on past performance.
The myth comes from the natural human tendency to extrapolate past successes into the future, fueled by media coverage of successful stock picks. Numerous studies, including ones published in the Journal of Finance, have demonstrated that past performance is not indicative of future results. Market conditions change, and a multitude of factors can impact a stock's performance. Instead of trying to pick individual winning stocks based on historical data, focus on a diversified investment approach. Consider using index funds or ETFs to gain broad market exposure, which is generally more reliable for long-term investment success. By gaining a solid understanding of these myths and the facts that counter them, you can make more informed and effective decisions in managing your personal finances. You must put the knowledge you acquire into practice, and if your financial situation has peculiar complexities, seek professional advice. Thank you for watching.